Today, we're going to attempt to answer a pressing question in the industry. Will whole life dividend rates go up? And if so, how much and when? I've heard agents pose this question and give their opinion without giving much insight into the dividend structure of a whole life policy or backing up their future call. That dividend rate is important because it makes a big difference in the compound interest effect in our cash value. More dividend means more compound interest, which means more available capital for our future endeavors. In today's video, we're going to take a look at the dividend of a whole life policy, as well as the macro outlook at the whole life's underlying assets. By the end, you'll have a good idea how the dividend works, a more informed outlook on the future rates of returns, as well as a broader outlook of the economy in general. So let's get at it. By the way, if we haven't already met, my name is Joseph Gutierrez of mylifeinsuranceBroker.net, and this is Covered in Compounding. For those of you that have seen a few of my videos, you know that I am passionate about using permanent life insurance as an asset class to expand our wealth. Its safe internal rates of return and tax-free accessibility make it a unique asset that can be quite useful. It's what I sell and represent, but I myself am primarily a full time investor and a small business owner, so I spend quite a bit of my own time analyzing potential deals and reading the tea leaves of the greater macroeconomy. Our channel here is multifaceted, and today's question is an intriguing one that we can dive deeper into than some of the mostly sales focused channels out there. So, to answer the question on where the whole life dividend rates may go, first we need to have at least a general understanding of how the insurance carrier produces their dividend. So, remember, with a whole life insurance contract from a participating whole life carrier, meaning one that declares an annual dividend, we are technically co owners with the insurance carrier, the mutual whole life insurance company. Just like if we owned a dividend yielding stock like Procter and Gamble, as stock owners, big or small, we have a right to the share of profits from the company, which is delivered to us as a dividend. And with a whole life carrier, we have much the same setup. As the company takes premium from us, they then invest and produce a decent rate of return based on the current market conditions. Our premium that we pay into our policy is placed in what's called the company's general account and put to work in safe, low risk investments. And by the end of the year, based on the profitability of the insurance carrier, they have the option to declare a dividend. All that said, it's important to remember that the dividend payout any particular year is not a guarantee, even though it's extremely likely. And when I say extremely likely, I mean just about all major mutual insurance companies haven't missed their dividend payout in 100 years plus. Okay. So we know that the insurance carrier is investing our premium and generating a safe, reliable rate of return that will be sent to us annually in form of a dividend. The next question is, what do these mutual insurance carriers invest in to produce that dividend in the first place? Well, when it comes to insurance carrier, we have to remember that they aren't like banks. In earlier videos, we described the fractional reserve banking system, how banks and credit unions essentially lend out 9, 10 to 1 on their banking reserves to make a profit. Banks are always super levered up, which historically makes them very susceptible to failures and bank runs. We have the late 1800s, early 1900s as evidence of this, and even the most recent with the infamous Silicon Valley bank failure. Even with the FDIC insured depositors' funds up to $250,000, we still see banks and credit unions walking the tightrope of profitability and possibly cascading losses. As a side note, if you looked at how underfunded FDIC is, you'd likely be very nervous about banks in general. Luckily, insurance carriers can't be as irresponsible because they are contractually bound to pay out large death benefits at any given time. They can't play fast and loose with depositors' funds like banks do. They must have a one-to-one requirement of fund reserves to cover death benefit claims, which makes life insurance carriers very conservative in their investment choices. Depending on who you talk to in the financial industry, many will admit that life insurance is one of the safest assets out there and at times have been referred to as a de facto secondary banking system, even though technically it isn't one. So, getting back to the question, what do these whole life carriers like to invest in and still get a decent rate of return? Well, with life insurance companies, they prefer to invest in as close to risk-free rates of return as possible, namely fixed income. And when I say fixed income, I mean mostly U.S. Treasury bonds. They have other bonds like AAA corporates or mortgage bonds or maybe a small amount of equities, but majority of their general accounts portfolio is U.S. Treasury bonds. Safe, steady rate of return. Okay, so to forecast future dividend rates, we should pay attention to what the U.S. Treasury market is likely telling us as a harbinger of things to come. Currently, the average whole life insurance carrier dividend rate is somewhere between 5 to 6% plus as a gross dividend rate. That said, this dividend rate can and does change over time as the market does. If Treasury bond yields go up, then we can expect the whole life dividend rate to start going up as well. And if they do, they can significantly increase our cash value over the long run. So let's do some basic analysis of the US Treasury market and see if we can get a good idea of where things may go. Okay, so now we're going to take kind of a broad look at the 10-year bond yield. Okay, the 10-year bond yield is kind of the gold standard of the Treasury market. It's kind of what a lot of professionals take a look at when they're trying to analyze where the bond market has been and where it's likely to go. And that's what we're going to do today and we're going to attempt to do. Okay, this is my opinion. This is just based on my analysis. You may come up with your own analysis that may be different than mine, but we'll go ahead and take a look and kind of do an overall encompassing analysis. So what I like to do when I'm analyzing whether it's a stock, Bitcoin, the bond market, I like to take kind of a fundamental look and I like to take a technical look. Okay, so technical analysis, we look at volume and price action and patterns and momentum indicators to kind of get an idea of how the past events will potentially predict future outcomes. It's one of those things that at first glance is saying how does looking in the past going to affect the future, but it's been well established as a fairly reliable indicator. It's not 100%, but if hedge fund trading desks put hundreds of billions of dollars into having traders utilize technical analysis, chart patterns, and things like that to make money, we can kind of safely assume that there's something to it. So it's only part of the analysis that I like to do. So we'll do that as well as kind of take a fundamental analysis look of the economy in general in terms of the bond market and the greater global economy and macroeconomy. So first things first, when we take a look at our chart here, we're looking at a uh, multi-year chart basically dating back to the early 1950s all the way to today. What's interesting is we're going to be looking at this chart. This chart is a 12-month time interval here. So every candle is 12 months or 1 year worth of price action. Okay, so we see these bodies and large wicks patterns, things like that, that kind of tell us what has happened in that year of price action. Okay, so if you're new to technical analysis, there's plenty of videos on the internet about this, but we'll kind of just have a generalized look for today. First things first, we're looking at the Heikin-Ashi candlestick pattern. I like it. It's a little bit better for pattern recognition. Kind of takes a more smooth out look of that year's price action. A few other things here. We see that there is a red line here and a green line. So these are the Bollinger Bands. It's basically a 2 standard deviation off of the mean of some of the price action here, essentially meaning that if our candles here are pushing up against, say, the green line, or excuse me, the red line, then we know that we're kind of more in an overbought condition, or at the very least, a very strong uptrend. And if we're against the green line, that's kind of more of an oversold condition or a stronger downturn. Okay, they're kind of generalized boundaries. The other lines here that are pretty important, the orange line and the blue line. So the orange line here is a 9 EMA, so the 9-year exponential moving average, while the blue line is the 30-year. Okay, so 9-year EMA. It's just a moving average based on the last 9 years of price action. Kind of computes out and smooths out with the exponential component of it to give us a line that's moving along the chart here. While obviously the blue one is 30 years for the average 30 years of price action. How they interact will kind of tell us of things to come as well. So it's pretty important. We're not going to spend too much time on the bottom of this chart here. Okay, this is just a momentum indicator. It kind of gives me an idea of entry points, and this is kind of the stochastic RSI. Kind of tells us very similar to the Bollinger Bands if we're in an overbought, oversold condition. But so let's kind of jump into this. So if we take a look at our chart here, we're going to see for the first, since about 1950s is when we start to see a kind of a meaningful breakout in this sideways action from the early 1940s all the way to 1981, where we see kind of almost like a blow off top here in the bond market. Okay, so we see a run up in price and then a corresponding run down in price from 1981 to about 2021. So about 30 years up, about 40 years down. And then we see some action on the last 3 years here in terms of price action. So before we get too far into it, let's kind of split it up and look at the first few years of this bull run in yields, if you will. So if we kind of zoom in here, we take a look when it gets started, we see these 3 green candles starting from 1951 to 1953. We see higher highs and higher lows, okay, for each one of these years. So this basic pattern here it's known as the 3 white soldiers. Basically, it is a increasing trend that's taking place. We see the 9 EMA starting to curl up, and a new trend is forming to the upside on yields. And we also see a few years later where the 9 EMA moves up and crosses this 30-year EMA. And this is known as the golden cross. Okay, this is one of the more powerful indicators in technical analysis, where when this happens, when a lower EMA crosses a much higher EMA, in this case a 9 to 30 EMA, it gives us confirmation that a new trend has been solidified and the market is starting to move up with conviction. Okay, and we can see that over the next close to 30 years here, where we top out at we started basically, let's see here, started about 2.5% on the 10-year Treasury, and we ran up all the way up until about, looks like almost 16% on the 10-year Treasury. Quite a bit of action here, okay? And up until that time, right around 1982, we can kind of see that we start losing momentum and then we start making a trend to the downside. So that's kind of like a brief technical analysis. What is the reason for this? So if we kind of peer up into our history books here, we kind of saw that during this time period, the U.S. was kind of the only industrial game in town. Europe was basically destroyed from World War II and was rebuilding. So a lot of the industry was in the U.S. We also had the war debt, and we kind of expanded our economy quite considerably and started taking on more debt. Okay, anyone that has relatives or family or yourselves that have lived through this time period, we know that there was considerable amount of government spending, higher taxes. Remember, we had the oil embargoes, we had LBJ's Great Society, we had the Cold War, we had the moon landing. All of these contributed to higher inflation, more government spending, and a higher yield, because bond investors will demand a higher yield if there's more inflationary pressures. And this period of U.S. history was marked by a lot of inflationary pressures, in so much that in 1971, you actually see a little bit of distortion here with this red candle. That's when basically the U.S. was running up debt so aggressively that a lot of other countries were demanding their gold back, essentially, because back then the U.S. dollar was tied to gold, and at this junction point here, 1971, Nixon took us off the gold standard, and we essentially had our currency mostly floating. It eventually became the petrodollar and was used in kind of the euro dollar system uh, for cross-border payments and oil purchases and things of that nature. So it's kind of loosely floating depending on the bond yields of that time. But you can kind of see we still had very strong uptrending growth. We had quite a bit of government spending, high taxes, and a high inflation. Okay, so if we kind of move over here, we kind of have our little blow off top here in 1981, and we start to trend down. We see this kind of spinning top formation here. This is another basic chart pattern. It's basically saying that the market is indecisive. It's trying to move up, it's trying to move down, gets pushed up, pushed back down again, and it's looking for its new direction. And we kind of see that for the next 40 years here, we see a downtrend in yields. So what was the cause of this, right? We downtrend all the way to basically 2022, where we start to move back up again a little bit. So the basic answer to this is we had a large demographic shift here. This is when the baby boomers came into the workforce. Baby boomers being one of the larger population that we've ever had in demographic history here. And with that, they brought in a lot of basically deflationary pressure. More workforce, more labor, we can start to experience some level of deflation. Not only that, during the 80s all the way to the present day, we had quite a bit of globalization. Okay, so countries all over the world were now becoming more interconnected, right? All these different countries kind of moved into the marketplace and took up, their own respective places. We had different countries in Southeast Asia doing a lot of semiconductor trade, manufacturing from China, some of the manufacturing from all over the world, each country kind of taking up its own position and contributing. All these factors enabled what we can see here is a downtrend in bond yields because we had a deflationary kind of impact here. Okay, so what we see here as we get to closer to the present day. Well, obviously, we all remember kind of the COVID time period. And what was the government response to COVID? Well, on a fundamental analysis, if we kind of look at the charts or look at the data, it's quite obvious we printed a whole bunch of money and flushed the system with it. It's about 7 trillion or so of funds were kind of produced by not only the U.S. but another considerable amount of trillions of global currency was floating around the system to manage the crisis. And in doing so, it caused inflation. So when we kind of zoom in here, going back to the technical side of things, that inflation kind of shows up in the chart here, but we see a very similar pattern. We see a very similar pattern to the early 1950s of 3 green candles of increasing highs and increasing lows. We also see, if I kind of click the settings here, if it'll let me, there we go. We can kind of see underneath the bars here that the 9 EMA is starting to curl up and it's approaching the 30-year EMA. This portends that a golden cross back to the upside is somewhat imminent. And we're seeing that the market is demanding more yield. Okay. So we kind of went over kind of a brief analysis here. We see that if we really zoom out, we kind of see that history is somewhat repeating itself, right? To a lesser degree, the amplitude here on these candles aren't nearly as big as today, but we are seeing that we're going to a inflationary cycle, okay? Based on now, if we really look at the data, demographic data, we see that a lot of the Baby boomer generation is now retiring, they're leaving the workforce, and the new generation of Gen X and millennials aren't as big. Not only that, a lot of other countries, namely China, are going through demographic collapse, and they're not able to produce goods and services at the same level as they once were in the 90s and the 80s and early 00s. So what we're seeing here is basically reindustrialization, reshoring, and a deglobalization effort. And deglobalization and a smaller workforce at home and abroad basically point to an inflationary cycle. And we've seen that in the last few years of ever increasing inflation rates and now an increasing bond yield. So, with this information, kind of a brief analysis here, I can give like a very generalized prediction, if you will. And now, this is my own analysis. This isn't meant to be taken as financial advice. It's just the analysis that I've come across here and my own opinion. So, I like to look at a prediction as more like an event schedule. So, if we continue to see movements on a technical analysis here, movement of increasing price action, higher closes, higher buys of the 10-year Treasury yield, and not only that, if we see this orange line, the 9 EMA cross the 30 year EMA, then we know that the market is moving upward with conviction, and that basically we may have another large increase in the yield again. And if we look at the history of the 10-year Treasury yield and how it kind of connects to the whole life dividend yield, we kind of see some similarities. Come back here, looking at one of our featured carriers from the last video, Lafayette Life, we can see how the dividend yield today is about 5%, a little over 5%. But back in 2001, we were closer to 8%. 1990, closer to 10%. And when we look back at our chart here, 2001, we see that the yield was pushing up against 6%. 1990, we were closer to 9% on the 10-year Treasury, the yield. So we can see that if the market keeps moving up with conviction, then we know that we're likely going to have a higher compound interest effect in our whole life policy. Now, do I think this is going to happen next week, next year? Actually, no, I don't. So my answer is kind of multifaceted here. In the long run, I foresee that we're going to have stronger bond yields, and in connection, we're going to have stronger compound interest inside of our whole life policies, and by extension, index universal life as well, to some degree. On the short end, I don't quite see that. So I see some signs of basically some headwinds in the market. And I'm not going to go too far into it, but just a little bit of a taste of it. We've already seen the 2 to 10 year inversion and re-steepening, which portends to usually recession or at the very least some chaos in the bond market. We've seen the copper to gold ratio kind of go out of whack. Copper being a proxy for economic development, industry, real estate. If the copper price is coming down, then that means there's less demand, less economic activity in industry, and we're seeing the gold price come up. We're seeing usually gold as a flight to safety in times of uncertainty. Not only that, we're starting to see some bond yields compress in other countries. China, Germany, bond yields are compressing. We're seeing labor data coming down. So we're seeing less companies are hiring, fewer open jobs out there, and I suspect we'll start seeing more cascading job losses in the years to come here. And a few other things we see in the short-term treasury market. The SOFR rate is coming down, the secured overnight financing rate, which is kind of the rate between banks and hedge funds as they kind of borrow and use the treasury bonds as collateral. We're seeing that rate coming down, which usually portends to decreases in the repo market rates as well as the Fed funds rate, which we've already seen. The Fed funds have already come down about 100 basis points, and the market had a little spasm here when the Fed said that it was going to halt their lowering of Fed funds, which I don't think is going to happen. I think we're going to see quite a bit of chop. Ultimately, how it affects the U.S., it's hard to say. The U.S. is usually insulated from kind of global issues. What I do see, though, I do see some kind of supply shock, uh, macro kind of global recession, and how it affects the U.S. is going to be interesting to see how that plays out. But I suspect if I were to draw this out on the screen, I suspect that, let's see, we're going to see the yields come up probably to the 30-year EMA, and then we may see a rejection where if there is some kind of global crisis or a recession, usually what happens is the Fed drops interest rates quite chaotically, and investors pile into the safe asset, which is the U.S. 10-year Treasury, bringing yields down. So what I likely will, in my opinion, what likely will happen is the U.S. Treasury probably will bounce around here for a few years before we see it move back up with conviction. Okay, so my analysis here, basically, I foresee that the market is going to chop for a little while, but eventually we're going to see higher bond yields and by extension, higher whole life interest rates and compound interest effects in our policy. So thank you for watching our video on the analysis that we did here on the bond market and by extension what I think the future rate of return in the whole life dividend space will be. And if things work out the way I think they may, I think over the next 10, 20, 30 years, people who have whole life policies that have built up a decent sized base and a dividend are going to be producing much stronger compound interest, building our wealth, allowing us to do more with our cash value over the long run. As always, thank you for watching our video. If you are interested in putting together your own whole life policy, feel free to click the link in our description. It will take you to our website where you can fill out a short form, kind of tell us what you're looking to do, and it'll also take you to our scheduling page where you can sign up for a free online consultation with myself or another agent, okay, where we kind of go over your financial situation, what you're looking to accomplish, and how a policy can best fit into not only covering your family, but also providing them with considerable amount of returns inside the policy that we can use to acquire other assets along the way. Thank you for watching. Click like and subscribe for alerts on future content. And I look forward to seeing you on our journey towards financial independence using the foundational asset. Until next time.